You hear traders often talk about false breaks or fake outs, a topic which we have previously covered in the key reversal pattern series. But what happens when a false break is not really a false break and is in fact a continuation of the underlying trend? Anticipating and spotting these false fake outs can lead to great trading opportunities, and this is the topic of our discussion in this video. Hello traders, I'm Fawad Razaqzada, market analyst with Think Markets, and this video is part of our series on trading the failure of key reversal patterns. So how exactly can you anticipate and spot the failure of fake outs? And more importantly, how do you trade it? So as price approaches an old key high, one of two things could happen. First, a clean break, or you have a brief break followed by a quick rejection. Yet a third scenario is when you have a brief break followed by a quick rejection and then a continuation higher. So in other words, the failure of failure. Now this failure can sometimes be anticipated. First, you could look at correlating markets. For example, if the euro dollar and the Aussie dollar have already broken their corresponding old highs, but when the pound dollar makes what looks like a genuine false break or a fake out at its old high, then you know that this fake out is most likely to fail the sellers eventually, because the US dollar has already made a new low against the euro and against the Aussie. Another way of anticipating the failure of a false break is by watching how price approaches the old highs, because that can give you good clues about what might happen next. So first, if price makes a steady progress, making interim higher highs and higher lows beneath the old high, then it will most likely break through it cleanly. Secondly, if price consolidates in a tight range for a number of days below an old high, then this consolidation would strongly suggest a clean breakout is on the cards. So in these circumstances, if you see a fake out on the lower time frames, then you know that this is probably not a genuine false break, and you can think about fading that fake out by looking for bullish trades. However, if price makes a big move up without a pause to test the old high, this is when a genuine false break can happen, as price has already traveled a long distance and lots of buyers would be keen to take profit around the old high. So you have to be careful in that scenario. The beauty of trading the failure of a fake out is this. First, you are trading within the existing direction of the trend, in this case an uptrend, which means you're automatically giving yourself a better chance of making a successful trade than when going against the trend. More to the point, when a false break fails, this can lead to a sharp continuation higher. The interim false signal, that is the fake out, encourages many people to short the market thinking that the top might be in. They will sell short and place their stop orders just above the fake out high that was created. As lots of buy orders accumulate above this high, this means that in the event of a failure of a false breakout reversal, the move to the upside could be explosive as a cluster of buy stops are triggered. This therefore means that the potential upside could be significant in relation to where your stop loss order would be resting, which in this case would be below the most recent low that was formed prior to the latest breakout. Now, fake outs, or in this case false fake outs, can happen on both sides of the ranges, and this is how a false fake out would look like on the downside. Here we have an example of a failure of a fake out on the downside on the daily chart of the dollar CAD. Price stages a decent recovery and it looks like a bottom has been formed until price then crashes back into that level to form on this day what looks like a possible false breakout scenario, with rates going below that level but closing back above it. And indeed on the next few days, price continues to hold above it, suggesting that price may have potentially formed a low, but price never goes on to make a higher high above this recent high, and instead what happens, look how it drifts slower and back into that level. So the fact that it has struggled to stage a more meaningful recovery here, this will give you a strong indication that rates want to push further lower. So one of the ways you could trade this is anticipate the breakdown and go short on the retest of the recent lows, placing a stop above this last bearish thrust candle that looks like will lead to a breakdown, which In this case, it indeed has. And then what you can do is bring that stop loss lower to above this high as rates continue lower. Or an alternative way to get on board is wait for a clean break below the fake out level, which we got in this day, and you can literally trade that short on the very next day, placing your stop loss above the high of that thrash candle that led to the breakdown. Trading pattern failures is one of my favorite ways to engage with the markets, as it can signal a strong continuation in the underlying trend after offering some false hope for people looking to trade the reversal of the trend. False signals and false hopes get people trapped and sometimes in real trouble, but equally provide liquidity for those looking to trade the continuation. Being aware of such scenarios can reduce the risks that you're not one of those trapped traders, but quite the opposite. Trading pattern failures often provide you with a strong idea where price is heading to, in most cases above or below levels where trapped traders, stop loss holders would be resting. However, it does require some thinking outside the box, and in this series my aim is to get that across to hopefully equip you with some of the knowledge I've acquired over the years.